Budget 2009, brought to you by Deloitte.
Let me share with the House the Treasury's expectation for the South African economy over the period ahead. Incomes and outputs slowed sharply in the second half of last year, bringing growth for 2008 to 3.1%. With commodity prices generating lower export earnings, with weak consumer spending and with slowing private sector investment, growth for 2009 is forecast to be 1.2%, the lowest rate of growth since 1998. We lived with 4 years of growth in excess of 5%. Growth for this year, we say, will be as low as 1.2%. We expect output growth to improve next year, supported by public infrastructure spending, lower interest rates, the 2010 FIFA World Cup, and the recovery in the world economy. But trading conditions are tough and are likely to deteriorate further in the short term. In 2008, South African producers were affected by a series of economic shocks, including electricity shortages, rising input costs, high interest rates, and slowing demand. This led to a marked slowdown in consumer-oriented sectors and weak mining and manufacturing output. Several sectors, including mining, manufacturing, retail trade, and residential construction, have retrenched workers, and the pace of job losses may unfortunately accelerate further. However, civil construction has performed well, supported by ongoing infrastructure investment. Our agricultural sector has grown strongly in response to higher prices and better rains. Sharply lower oil prices. A barrel of crude oil has fallen by 69% from a peak of about $145 a barrel in July last year to about $45 a barrel at present. This reduction will, of course, help to cut our import bill, but we are also experiencing a simultaneous fall in export earnings. The platinum price has fallen by about 60% from a high of $2,254 an ounce in March last year to about $980 an ounce currently. Part of the price concern in platinum is that it drives two worrisome sectors. The one is automobiles, which are in decline, and the other is high-end jewelry. And when the bankers on Wall Street can afford the jewelry again, it will be great for our platinum sector. We have to hold out until then. Lower consumer demand and the softer exchange rate will dampen import demand this year, but infrastructure investment will continue to draw in capital goods. This will continue to generate a sizable current account deficit, expected to average 6.7 a year over the period ahead. Over the past 5 years, the financing of our international balance has been heavily dependent on portfolio inflows to the equity and bond markets. Though still adequate to finance the current account deficit, the composition of inflows changed significantly last year, including an increased use of loan financing and repatriation of foreign assets by the banking sector. Our development expenditure over the period ahead will require both improved domestic saving and continued capital inflows. And so a sound banking system, a healthy fiscal position, credible monetary policy, and appropriate foreign exchange regulations will continue to limit our exposure to the international downturn while serving as key building blocks in financing future growth and development in this country. The soundness of South Africa's financial system was subjected to an international assessment last year, which concluded that our banking system is diversified and is supported by an appropriate financial infrastructure and a generally effective regulatory framework. Let me pause and simply say that this financial sector assessment program confirms that the banking sector in South Africa is sound. It's not It's not a point that they would hazard making in many countries on this globe, but it's a point that they have made about the banking sector in South Africa. Although our banks were not significantly exposed to subprime-related products, they are nonetheless affected by deteriorating credit conditions. That our banks are mainly capitalized in rands is an important strength. This is a key element of our evolving macroprudential framework. Nevertheless, it is incumbent on us to remain vigilant, to sharpen our regulatory oversight, and to work with banks to identify any potential problems early and to deal with these decisively. Credit extension has slowed probably more rapidly than is desirable. We expect our banks to continue to extend credit to worthy customers, noting that it is precisely the rapid withdrawal of credit that has plunged much of the developed world into crisis.